You're listening to Investify, preaching financial independence and assisting investors to achieve a more flexible and free lifestyle through smart financial planning and real estate investing. If leaving the corporate world and jumping into this thriving industry is what you desire, tune in and listen to stories of like-minded individuals who made the leap to financial independence. Equip yourself with the right tips and tricks to start your real estate journey, making active or passive ventures that are highly profitable and rewarding.
Hey everyone, before we get into this week's episode, I just want to put out a quick disclaimer that today's guest provides a lot of great information. He's really smart. However, he does not have the best reputation. I think he's out of that. We are giving him some grace, but he did claim bankruptcy a little while ago. He failed to return money back to his investors and all that. So we just wanted to remind you guys that before you do decide to invest any money, before you do decide to actually move forward with any partner, be sure to do your background research on them and ask them good questions and do your due diligence, because at the end of the day, anybody can get on a podcast, anybody can go on YouTube, anybody can start an Instagram, and you don't know where they're coming from or where their heart is. So make sure that you do your due diligence. And again, we, on Investify, we think that people make mistakes. I think we've all made them. I do think Sief is a good person. He's got a lot of great nuggets. He's extremely smart. I just think he got into a little bit of trouble. We're willing to give him grace, but we're just asking you, if you do decide to invest with him or anybody that we listen to on the show, or anybody that you listen to on this show, to just do your research, do your diligence, as we are not responsible for the money that you send these people. Again, thanks so much for listening, and we'll see you on the episode. What's going on, everybody? You are listening to Investify. My name is Craig Curlop, aka the Fi Guy, and I'm here with my co-host, Miss Allie Garcet. I love how Allie now she starts getting her pregame dance up even before I'm there. So yeah, I love it, Allie. How are you doing today?
I'm really good, Craig. I took the early morning off. I went on a breakfast date with my wife, and that's the life of an entrepreneur. I love that I can just
What'd you
block
get?
off time. We got vegan pancakes. We're on a vegan kick. Don't know how long that's going to last. I am losing weight.
Allie, I'm judging you.
Go ahead. I'm judging myself. I allow all judging. So yeah. I am losing weight, but I don't think it's because of the vegan stuff. I think it's because the frozen meals that are vegan that we're eating are so small. I'm just in a constant state of hunger.
Yeah, and maybe you're not getting the nutrients you need, but that's neither here nor there.
Nope.
I've got a friend. It's funny, and they've created a whole brand called Waffles on Wednesday. And it's funny because we recorded this on a Wednesday. Maybe you know them, Ray and Sarah. And they did the whole thing because, hey, if they want to wake up and have brunch and waffles on Wednesday, then they're going to do that because they don't need to work anymore because they're financially free, or they're doing the entrepreneur thing. So
yeah, I totally forgot about that. Yes, that's exactly what we did this morning.
Amazing.
Yeah.
Well, speaking of waffles, we've got our friend Sief Khafagi coming on. And Sief is done something in the short-term space that I have never heard of. And I just think it's incredible as to the innovative mind he has and what he's doing and what he's done in just such a short amount of time.
Mm-hmm. Yeah, he's a creator for sure. And, he's taken his creative and also frugal mindset from, he discusses his background growing up with immigrant parents and immigrant family, worked for Facebook and surrounded himself around people, even within the Facebook community, that were also creators. So, left what people would otherwise call a secure career, good W-2 job profession, and started real estate. So I think you're going to like this episode.
Yeah. So without further ado, let's bring on Mr. Sief Khafagi. I love his name.
Khafagi.
This episode of Investify was brought to you by the Fi team, a team of investor-friendly agents that service all 50 states. If you are looking to house hack, to invest, grow your portfolio, and want a true investor-friendly agent on your side, go to thefiteam.com and click Get Started, and we can't wait to have a good conversation with you. Sief Khafagi, welcome to the show, my friend. How you doing today, dude?
Hey, Craig, I'm doing really well. Thanks for having me.
Yeah, man. Thanks so much for coming on, dude. So pumped to have you and to hear a little bit about your story. So, like any good story starts, why don't you take us from the beginning as to when you first heard about financial independence?
Yeah, so I grew up in an immigrant family. Both my parents worked odd jobs. I tell stories sometimes of my mom stuffing the couch literally with money, and other parts of her bedroom, because that's just what we knew, right? You brought in money, it was cash. You put it somewhere and you protect it because no one can take it away from you, right? And then I'd eventually end up in um, going to college for a variety of things, and almost wanted to drop out. And I always started side businesses on the side, right? Like selling cars or flipping cars, I should say. Or, I think even when I was younger, I was selling like Pokemon cards and trying to flip those back in the day as well, right? Still have those Pokemon cards actually, probably somewhere in a closet, probably worth a decent amount of money. But ended up at Facebook after college, and that was the first time in my life that I was like, wow, I'm in a career surrounded by a lot of smart people, living in California, making more money than I knew what I could probably do with at that time. Because I grew up super frugal, super, low income. I was like, I don't know how to spend this money. I don't know what to do with it. And, I know that's a very privileged thing to say at the time, and still is. But one of the first things I realized right away is I don't think this is what I want. Right. I don't think what I want is to continue working in, big tech and big companies. And, it was great during a time of Facebook's growth because you were really learning a lot. And, you start asking yourself, are you going to go chase the things that you wanted to chase? Right. I've always wanted to build a business, and I built several businesses in my life. None of them were obviously as successful as Techvestor is today, but those are all building blocks to getting to this point. Right. And the biggest thing for me is that really the thing that kind of drove me over the edge. I was at Facebook. My first son was going to be born in roughly like 15 days at the time. And I made the decision. I was like, damn, at this point, if I don't go build now, it's going to be, in my opinion, significantly harder to go build later. Right. It's just one of those thoughts that you have, I think, as a father or as a provider for your family. And look, I had golden handcuffs on, at Facebook as they call them, equity, great compensation, benefits, the immigrant family mentality where they're like, oh my God, my son works at Facebook, or my mom like raves about that. And you give all of that up for, to go build what you don't even know what you're going to go build, right? You don't know what it's going to go turn into. So that was really my biggest inkling of like, let's go and let's go get this done.
Like, how did you get into that mindset of like, one, thinking about switching, two, making the switch, and three, convincing your family that it was a good idea?
Yeah, I'll start in reverse. Like convincing my family, I think was, and when I say my family, I think my wife at the time, which was really easy, right? So she's incredibly supportive, has always been supportive. If you want to go do it, like I'll back you. Like let's go get it done. Like go have fun. I think she also understands that like my natural creativity in business is like doing things that aren't supposed to make sense. And typically in corporate America, that's like a big no-no because you're supposed to do things that make sense. And my family, like my mom, my dad, my sister, those types of things, that was a little different, right? It's they're all risk averse, complete risk averse, right? They're like, why would you go do this? Why would you give up these things? The mentality switch, I think I've always had the mentality switch of like, I can go do it. But I think for the first time in my life at the time, I was financially secure to go test out the waters. It was also during the pandemic, right? So, the world was changing right in front of me, right? Facebook was changing. You had layoffs potentially happening. You had shifts in mobility, shifts in mindset, shifts in opportunity, shifts in technology. I think all those things naturally if you ask yourself, what could you do in a time like this? This is a great time to build when there's the most stressful situations, the most change. And I don't think that's really going to happen again in my lifetime. So I took that as an opportunity to, if you're going to do it, go do it now. Not to mention, the biggest driver by far was, I'm having a baby in 2 weeks, right? So, well, one of the things that I've always promised myself is to be a present dad. And one of the reasons that matters to me is my dad had me when he was really old, right? And he was working a bunch of odd jobs to provide. And, I didn't have the best relationship with him over my life, but it's because I didn't understand, right? I didn't understand until I became a more mature male adult over time. And I was like, wow, there are a ton of pressures of providing that you don't really talk about as a father. And, I think, I was probably harder on him than I probably should have been. And that's not something I want to do. I wanted to do for my kids. I wanted to be present. I wanted to be available. And so, they're only going to get older, right? And the older they get, the more they don't want to hang out with me. So I had to get to that as quickly as possible.
That makes sense completely. And that's such a crazy difference between everything you knew growing up and then just doing the opposite. It's that change is so drastic. Was there a person or a book or like a podcast even that like that got you into real estate, or was there somebody that you were like replicating in those early stages of making the switch? Who were you looking up to?
Yeah, I think for me, I was fairly plugged into like the tech community just because of like being at Facebook and seeing all these things build. And the first opportunity I had to actually maybe leave Facebook at the time was a startup that myself and a few friends had built that got accepted into Y Combinator. And I actually made the decision at the time to not pursue with it, right? And that was my immigrant quote mentality, right? Of being that's the riskiest option, right? That company today is still doing well, and it's not something I have regrets on because I think it was right for my family at the time. And then I'd go on to build Techvestor today, but I think being surrounded by friends, those are in San Francisco at the time. People I think talk pretty poorly about San Francisco today, and I can understand their perspective on it clean and not being safe and those types of things. But I think your community and your culture and who you surround yourself at the time, for me, was a huge driver. I was around people who all they wanted to do was build, all they wanted to do was create. And, obviously without sharing too many secrets, like being inside Facebook's campus, you see a ton of things that are being built and being worked on that are just mind blowing in many ways. And they don't have to be mind blowing in terms of the consumer. It's just even like what the possibility of something like technology could do, right? Or how far it could reach, or the opportunities it could bring to people. And you ask yourself like, wow, like that's incredible. So just, I think being engulfed in that ecosystem really allowed me to understand that these things are possible.
I love that, man. And so where did you kind of discover? So, I mean, Y Combinator, like, is legit. Like, it's probably one of the best like startup accelerators in the world, right? Was it Peter Thiel that started it?
I don't know if it was Peter Thiel. I wasn't super plugged in, so I wasn't the CEO
Okay.
at the time. It was a fellow named Kevin, but it was like the company we were working on together.
I see. Okay. So that's like a pretty big opportunity that you passed up. And so like where was your mind at when you said no to that? Like how did you come to that decision? And then like when did you decide to start going off on your own?
Yeah, I mean, I think I was in a provider mindset, right? I think, and I look at Kevin and Derek and the company that we were building together, and we actually brought it together in a Facebook conference room because two of us were ex Facebook, or well, two of us were at Facebook at the time, Derek and I, and Kevin was in town, and we were hammering out the idea and we were building it together. But I think the biggest thing for me is we were just in different points in our life, right? Like I was in a provider mentality. I was taking care of my girlfriend at the time. I was taking care of my mom. I was taking care of my dad. I was taking care of my sister, right? And I wasn't in a position where I could go eat ramen every single day and build a startup from scratch. And that reality scared me. And I think there's some people who may listen to that and say, "Wow, you really gave up a really beautiful opportunity." And I think opportunity is usually in the eye of the beholder and how they value it and they value things in front of them, right? And I think that's why time and timing is probably the most important thing in life. And at the time, that wasn't my time to go and build for the things that I needed to build. Do I regret it? Not at all, right? In any type of way. It was an opportunity that came up, and I think I learned a ton by observing and connecting with Derek and Kevin at the time, seeing how things were going and learning, and all those skills I think slowly compounded into what I would be building today.
And which takes you to where you are now, where you have a lot, where you focus on short-term rentals, right? So can we fast forward super quick, only to then come back a little bit later? What's your portfolio look like now? And then we'll take it back to the very first property.
Yeah, so today, Techvestor, to be very clear, like we're a short-term rental investment platform that helps people invest in Airbnbs passively, right? So the portfolio that I'm referencing is not one that I directly own 100% myself. We're the general partner. We obviously run and operate fine, do all the work, but we have roughly 120 properties. I think we're in 8 or 9 states across the country. We built that up over the last 2 years, and we've been really outperforming and crushing the market when it comes to short-term rentals and revenue and profitability there on a passive play. But our mission really is to make short-term rentals in a super accessible asset class, which historically it really hasn't been.
And now with short-term rentals just taking a massive plunge, like throughout the country, how have you weathered that? And what are you doing with your clients to be able to maintain cash flow?
Yeah, I think a couple comments there is, I think when people say that Airbnbs or short-term rentals are plunging, I don't believe that's what the data actually says. And I think those are probably some large media headlines where people are just reading above the fold and not below the fold. So if we actually look at the data, Airbnbs are actually not taking a plunge in most markets, depending on if you're looking at the right data, right? Jamie Lane, who's the chief economist at AirDNA, has debunked that for really all year. He's an advisor to us as well. The data we have directly is actually showing we're doing better year over year than ever before. And I do think that there's a large influx of short-term rental supply that has happened over the last kind of 12 to 18 months for sure. And I think you're seeing the bottom get squeezed out, right? The folks who have the super normal property, the 2-bedroom condo, who they can't rent it out because they're competing with hotels. We're a very different beast, right? Most homes we buy are 4 bedrooms and larger. We self-manage, we self-operate, we design and amenitize to the tens. And, I'm talking about golf simulators and mini putt and bowling and movie theaters and pools and hot tubs. And, our homes are typically 75 to 85% occupied all year, and they have been all year. And every single month this year, we have beaten our revenue expectations by an average of about 22%. Now, I can't speak for the entire market, but I think this shows the opportunity that a professional operator has in the space. But probably more importantly, to your point, Ali, I think it's people bought homes and they designed and operated it for themselves. We buy, design homes and operate it for the guests that are coming to our homes. And while it seems like such a simple shift, that's all business really is, right? It's building for the avatar, your ICP of who's coming, who's delivering that experience to. So we haven't seen a downside in revenue. I don't believe we will, but we'll see where the future lies.
Sief, I've got a couple questions for you on this. Okay, so the first one is it worth the additional investment? Right, because I'm hearing all this golf. I know golf simulators are like 20 grand, right? You're talking about putt, golf court, whatever. All this stuff, it's not cheap, and this is stuff that you would not need in a typical real estate investment. So, what's the payoff for all this additional stuff? And then, how often do you have to keep updating it?
Yeah, that's a great question. So, Airbnbs and short-term rentals are part business, part real estate, and arguably more business than they are real estate, right? In many ways. So, every decision we make is data driven. Like when we add a hot tub, we know that it's going to cost us, call it 10 grand, wiring, hot tub, everything. And we know that it's going to drive an extra X in revenue. So like in one of our markets, with the data tells us adding a $10,000 hot tub drives $30,000 in additional revenue on average, right? For the year. So you make those types of decisions. The other thing that we do is we have to ask ourselves, if we're going to own this home for the next 8 years, like we have an 8-year North Star internally, what are we going to do to this home to ensure that we can continue to operate it, be competitive, and drive the type of performance that we want to drive? And we believe the future is moving towards things like mobility and access and amenities and these larger group travels, and that's where all the data again is pointing to. The cost of things like a golf simulator is far, far, far lower than the ROI than you'd be getting. Right. What I mean by that is you are getting such a great ROI on these types of things if you know what the amenities are that you should be putting in your market. Do I put a golf simulator in every single market? Absolutely not. Right? Does a golf simulator go in Florida? Yeah. Would a golf simulator work in Scottsdale? Yeah. Would I throw that golf simulator out in that mountain cabin? Probably not. Right. Like you have to understand who's coming to your home, what they're looking for, and also what separates you from the rest of the crowd. Right. So a lot of things that we do is just shrewdly suited in that data, and we optimize for two things, right? Cash on cash, which is just optimized for cash flow, right? We investing for cash flow today, and then ultimately packaging the portfolio and then selling it over a period of time and getting that equity pop, and obviously whatever that eventual IRR is going to be. So yes, every decision we make, every amenity we add is completely data driven from the get go.
How many markets are you in and where?
So we're in places like Scottsdale, we're in places like Clearwater, we're in places like the Poconos, Blue Ridge in Georgia, McGaheysville, Virginia, and some of these markets you might hear and you're like, where is that? And that's the point. We don't invest in like tier one markets that are, downtown New York for a variety of reasons, like regulatory concerns. The numbers don't make sense. But where we invest are where the price to rent ratio makes a lot of sense. So the 10 markets, give or take, that we're in today, we can buy on average a $550,000 house that's going to do $120,000 plus a year in gross annual revenue, right? And of that, we're going to take home, anywhere between 35 to 55% of that on a net basis, right? And that's something that we're very, very comfortable with in terms of those margins. We are also believers that we want to hoard real estate, right? Like we believe real estate 10 years from now will be significantly more expensive than it is today. We believe supply will be a problem in the future, and we want to be on the side that owns it today and can refinance it tomorrow, right? That's what we believe, and we want to own and operate in good places, in good locations, with good guests.
Sief, it's people like you that chased me out of Airbnb. I could,
it's
I wish I could show you, my man, my first. I mean, I guess I could show you if I could dig up the pictures. Like the first pictures of my first Airbnb in 2017, it was a joke as to how much I was making based off of the amount of effort that is put in. Like it would not pass today. But
it wouldn't pass. It was the IKEA days, Craig, right?
yeah,
We call it the mom and pop days because we actually have a slide in our deck, and it's like, here's what our competition looks like. And the most common comment we get on that photo, someone said, is, it looks like my kid's dorm room. And I'm like, exactly. Right.
that is like exactly what mine looked like. Like I had the American flag comforter. I had like the $30 desk, not a picture on the wall. Yeah, it was pretty funny. But no, that's awesome, man. And so when you're analyzing a property, like what are some of the things that you're going to look for? I guess first off, what are some of the red flags? Like what is something that you're like deal breaker?
Yeah, so we use a technology and a human driven approach at the same time. So kind of give you guys like the funnel for how we like evaluate a property, both good and bad. So first and foremost, we know that we can't be everywhere at the same time, right? We built our own custom software that underwrites over 257 local markets. We underwrite over 100,000 plus properties a month as soon as they hit the MLS. We also get off market inventory. And 94, 96% of the time, the deal sucks. The numbers on an arbitrary basis, what I can buy it for what it's going to do in revenue, don't make sense, right? So let's right then and there, like we're looking at price to rent ratio as our first indicator. Without price to rent ratio, because every home is going to have costs, and we generally know what those costs of upkeep are going to be, right? And so if it doesn't meet our ratio, there's no reason for us to look at it. After it meets our ratio, we need to understand, is there enough physical real estate supply to buy this type of product? So in each market, there's usually an optimal type of product to buy. Say, for example, a 4-bedroom or larger with a pool on a certain acreage of lot in a certain part of town, right? So your buy box goes from the entire country or all the 257 local markets that we're mapping. It dwindles down immediately by about 94% because the numbers just don't work. And then from there, you start to identify pockets based on the data and trends of what's working in each local market. At this point, it becomes really hyper local, right? What works in Scottsdale doesn't work in Clearwater, doesn't work in the Poconos, doesn't work in Blue Ridge, doesn't work in McGaheysville, doesn't work in San Antonio, doesn't work there, right? It's a different type of product for a different type of avatar. And so from there, you start to look at hyper local data. For example, in Scottsdale, I'll never own anything that's less than a 4-bedroom. I can tell you by the data, the numbers never make sense. I can also tell you that I'll never own anything in Scottsdale that doesn't have a pool. And also tell you I'll never own anywhere in Scottsdale that isn't on a certain acreage of a lot, because I need to be able to create the resort-like experience in the backyard that is going to be commanding the premium that I need to command in that marketplace, right? So those are the types of things that we're looking at on a high level basis. And then you're starting to look also at physical real estate supply. Now that you know what's an ideal Airbnb in that market, you ask yourself, okay, and this is something we have to do because we're not your typical mom and pop owner where like I can buy one, right? If I'm entering Scottsdale, I want to be able to buy 25. I don't need to buy 25 tomorrow, but I need to be able to buy 25 because we get significant advantages in economies of scale. You have in-house labor, in-house maintenance, all these advantages you talk about, Craig, competing against someone like yourself. Not only do we win on things like design and pricing, but we win on labor and operations because of economies of scale over time, right? And so we ask ourselves, okay, is there enough physical real estate supply coming to the marketplace of our ideal product? And if that answer is yes, we have an interest. And then only at that point do we start looking seriously at regulation. We generally have an idea as well, right, before we enter and even like map these markets about regulations, but we're not usually investing in markets with tight regulatory concerns. So for example, in the state of Arizona, it's a buy right thing. It's state legislation that you can Airbnb your home essentially, as long as it's not an HOA, right? It's a buy right thing. In the Poconos, $3 billion worth of revenue funds schools, roads, and infrastructure because it's primarily a destination, second home type market. In places like Clearwater, we buy in unincorporated areas where the likelihood of legislation is highly unlikely anyways, right? So those, once we have all those things kind of checked out, those are the things that we look for. And overall, the first thing I would say to anyone who's looking at getting into Airbnb, the first red flag I would ask you is, are you going to make money high level? Back of napkin math, you're sitting at a bar, you have a drink, you're 2 drinks in, math is looking a little fuzzy. Does the price to rent ratio work? Because if it doesn't, you're wasting your time to begin with.
And what kind of price to rent ratio are you looking at?
So we look for a 17 to 21% ratio, depending on the market that we're in. Now, remember, we're a diversified portfolio, right? So we have properties that, and I know this is going to sound insane before I even say it, this happens every time. We have properties that we'll buy for 300 grand that'll do $130,000. And people ask us, well, why don't you just buy all properties like that? Right? Like, why isn't every property like that? And the reason is because there's an opportunity cost to not having diversification. There's a risk to not having diversification. So while we buy a lot of properties like that, we also offset that with properties in different parts of the country, in different parts with different seasonality, with different levels of demand, in with different risks like less insurance costs or less property taxes or whatever it might be, to have a diversified approach. So for us, 17 to 21 is where we want to be. We've historically performed around a 26, right? So we typically underwrite conservatively. We, typically do fairly well. That also is because we need to run an institutional grade platform. So for the average mom and pop who's running a single property, they might actually be okay with a 12 or a 15 if they're self-managing, doing all the work. But at that point, you're exchanging your time for money.
Right. And so if I'm hearing you correctly, from 17 to 21%, you mean an annual revenue divided by the purchase price of the home, and that's the ratio you're saying, right?
Exactly, because we have an idea of what renovations are going to cost, what furniture is going to cost. All that's baked into that annual ratio.
Okay. And so and how are you getting that estimation on the rent? Like, are you going to AirDNA, typing in 4-bed, 3-bath in Scottsdale, or is there more to it than that?
Yes and no. So like we do use AirDNA. We have access to AirDNA's data. We also have access to several other data sources, and all of this feeds into our software. I mean, I kid you not, we probably look at over 1 billion data points. I wouldn't be surprised, right? That all aggregate into our system. And we look at that data, we look at trends, we look at different varying data sources. The most important data source over time to us is actually our own data, right? And this is the one we make the most decisions, because when you're comparing something like on AirDNA, it's comparing it to the comp set that exists, but we are significantly stronger and better than the comp set, right? Based on our own data in that exact market. So, these days, if I'm buying in a market where we already own 25, I'm really looking at my own data first and foremost, right? Because if I already own 25 and I'm buying another one and I'm doing 185,000, but AirDNA or something else or some other tools telling me that 110 is to be expected, it's highly unlikely we're going to do 110, right? Because I have 25 other first level data points with the exact kind of replica of what we've done, and here's what we're going to do. And again, we're not big enough where we're ever going to take down a market by being too big. Like we could own 150 in a market and not really move the needle. Once you start, if you're starting talking about owning 1,000+ properties in a market, right? Sure, you might be basically self-sabotaging and self-cannibalizing over time, but we are far, far, far from that today.
So for the average, back to like a mom and pop uh person, couple, maybe just a smaller partner scale that have short-term rentals, that have been feeling the high vacancy rates recently and just the switch, what would you suggest to them?
Yeah, I mean, this is actually probably the most common reach out we get from folks is actually existing Airbnb owners who reach out to us and they're like, "Do you manage?" And the short answer is we've never managed for a third party today. It may be something we launch in the future under a subsidiary brand or something like that because of all the tools and pricing advantages and all the knowledge that we have to actually go out and execute. But I think the first thing I would ask yourself is, what makes your property unique? And I think naturally most real estate investors are either not well capitalized, typically, because again, the whole mantra is own equity, not cash flows at times, right? Or they're reluctant to go make the changes to their property, right? Or it's really hard to do so. I would ask yourself, the property you own, what makes it different than the other 300 properties you have there? Second of all, are you investing in the right tools and technology, right? Are you using dynamic pricing? And if you're not using dynamic pricing, why the hell not? That's like an instant 10-15% lift in revenue, right? And more importantly, if you're not an expert at using dynamic pricing, you should let an expert handle your dynamic pricing, right? Because that is probably the number one area we invest in is in revenue management, right? We literally can move the needle by understanding pricing demand and pricing supply and pricing movements and our product is superior, right? Like we treat our product exactly like you would treat SEO on Google. And I don't think the average Airbnb owner thinks like that. You can go into your Airbnb profile. You can see how many people are viewing your property, what the conversion cycle looks like. What's the conversion cycle? Is it going up or down on a monthly basis? Why or why not? Where can you tweak your listing, right? For us, for example, we get roughly 2 times the views of the average property in our markets. We get 25% more clicks, 20% more bookings, usually at a 15 to 20% higher premium. I know my funnel, right? I know if one thing goes up, one thing goes down. I'm like, how do I improve that? Were we priced too high, too low? Did supply go up? So demand go down? Right? All those types of things. So if you're a mom and pop, go treat your property like a business, not a piece of real estate. Understand your funnel to bring in that customer.
Sief, I don't think I've ever heard anybody that knows their Airbnb numbers like you do. So that's incredible, man.
Know it like the back of my hand.
When you say it, I'm just like, yeah, that's so obvious because like we know our numbers. Like, as a team of agents, like I know exactly how many leads come in. I know exactly how long it takes our agents to call them. I know exactly how many phone calls it takes for them to get them on the phone. Like those are all things that you need to do so you can improve them. We hope this episode is inspiring you to take action. If you're thinking about becoming a real estate agent or an agent who wants to join an investor-friendly team, just hit me up on Instagram at the Fi Guy because we are growing our team in Denver, Seattle, San Diego, and Coeur d'Alene, Idaho, but also adding to our network in all 50 states. And if you didn't already know this, the Fi team provides a super supportive environment with one-on-one coaching, accountability, and ongoing training to help develop kick-ass, rock star, investor-friendly real estate agents. So hit me up on Instagram at the Fi Guy, shoot me a DM, and we'll set up a time to chat. Can't wait to chat with you. My question to you is, let's say you see something is broken, or let's say you see something's broken. I feel like you probably can find it and fix it pretty easily. Let's say you have your meeting with your team and you want to improve a metric. How do you go about doing that? And how do you know you're not self-sabotaging yourself by the test you're doing is not hurting you?
Yeah, so I wish I could show you guys our infrastructure because you'd look at it and you'd be like, but the reality is we track a ton of data, probably more data than I would ever need. And here's the reality that I know what I'm going to say isn't something that's easily available to the mass market. We built our own internal tools that allow us we export all our raw data from our property management system. We upload it to our own infrastructure, and we have our own proprietary tools that help us look at our business in a way that just doesn't exist on the market. The reason these tools don't exist on the market is there hasn't been another player really that's come and said, I am going to own 100+ properties. I need this tool, right? So usually people are doing it on a one-to-one basis, which is why we have to build it ourselves. So things that we look at, for example, that we can decipher is I can look at weekend occupancy versus weekday occupancy, right? And therefore I can dictate, do I price higher? Where do I have occupancy? That's going to dictate where you make your pricing changes, right? Because weekends in most markets should be really well booked and you get a ton of premium there. And on a Monday, you're giving it away for a little bit free than you might be on a Saturday. And that's totally fine. And the other thing around that is, when you get a booking, what's your booking lead time? I guarantee your booking lead time is different by month. I can tell you what our booking lead time is by day. I can tell you what our booking lead time is by season. People think of season, they think of fall, winter, spring, summer, right? 4 seasons of the year. What if I told you that we have about 37 different seasons in our analysis in our markets? Because we don't view seasons as time of year. We view seasons based on shifts of demand, right? And that's a completely different perspective than when people think about seasons. And if you're using a dynamic pricing tool, its version of seasons is what your and I's version of seasons is like winter, fall, like low season, high season. It's very surface level in terms of doing those things. And so when our team looks at our data and we're like, well, our weekend occupancy is down. Why is that? Right? How do we go? Do we need to lower prices? Often for us, it's actually the opposite. We book our weekends at sometimes 40 to 70% premiums over our comp set, but then we give our weekdays away for 10 to 20% lower than our comp set. Right? So is that a better trade-off than pricing the same price every single day? I mean, everyone will be the judge of that. But we know where to go point. We actually A/B test. We document all our changes, right? And so we typically aren't making 1,001 changes at a time. We're making calculated changes, watching the numbers grow. And we're also at a level of scale that as things happen in real time, because we pull our data every day, you start to see the needle hopefully moving up and to the right, as they like to call it.
Yeah, I think it's interesting, like just to think about split testing your like Airbnb business. And that's kind of what I was getting at was like, do you split test? And actually split testing the right way too, because if you're changing too many things on your site, you don't actually know what caused the change. So if you guys out there are thinking about optimizing even if you've got one Airbnb listing, change one thing, or just change the title, or just change the description, or just change the price. Have that data for a couple of weeks and then try to make an educated decision based on if the data has changed. And maybe a couple of weeks isn't enough time to have statistical significance. But yeah, man, I mean, I love how you're treating that stuff like a business. So like you saying you have 125 properties, like you own 125 properties. How are you able to buy these, like down payments, all that kind of stuff?
Yeah, great question. So we raised essentially what many would call a fund or a syndication, right? So we've raised over $60 million from investors, or as the industry would call it, OPM, other people's money, right? And the trade or our service, what we offer to investors is, hey, if you invest in our syndication, we'll do all the work, right? We're the sweat equity, right? And I'm talking to anyone out there who's a mom and pop who's always been terrified to go ask for other people's money. If you're good at what you do in whatever vertical of real estate that you're in, and you have an opportunity, the likelihood that someone wants to invest in that is actually rather high, because most people, the average Joe, does not actually want to go do the work. That's the hardest part of real estate, is doing the work, right? After that, people want to like glamour the cash flow and the equity gains and the tax benefits and all that. That's fantastic. And guess what? Your partners, your limited partners, get all those same benefits too, but they don't have to do any of the work. And so for us, over the last 2 years, we've raised a little over $60 million in equity. So that's where the down payments come from. That's where the renovation costs come from. And our offering to our investors is pretty simple. We've built this really awesome team. We've built this awesome technology. Here's all the advantages we have. That's our positioning in the market. Here's our track record. Would you like to participate in this with us? And that's been our success thus far. That's where all the money comes from.
Wow. And so it must have started with just you buying a couple yourself, right? You and your partners, and then having success and then developing it.
So, I mean, kind of taking us back to like day one. So Sabrina and I met together with Sam roughly in July of 2021. And we started actually as a software product. We built software. So I came to Sabrina, and we'd known each other in the industry for a while. And I said, hey, I want to buy 8 of my own properties. So my initial business plan was buy 8 Airbnbs, and you know what? I can retire. Like that's enough cash flow. Like we'll be good. And what I couldn't find is I couldn't underwrite them fast enough. This was also a time in 2021 where like real estate was still like wildly hot, right? Like if you didn't know about a property the second it hit the market, you were already shit out of luck, right? Like everything was gone. That house had 15 offers, all cash, like 17 over ask, highest and best. Man, I hope I never hear those words again, right? Like all those types of things. And, I needed a way to underwrite faster. And coming from tech, I'm like, why am I underwriting one by one? So we built our own software solution actually for ourselves, right? And we couldn't get the right properties fast enough. And so we decided to sell our software. We got a couple customers. And the problem we saw is when people used our software and they found a property, they churned, they left, right? Which is, people were like, people were telling us, well, like it did what it was supposed to do. And I was like, no, you don't understand. Churn and software don't go together. It's horrible, right? Because the customer leaves. So we transitioned over to a managed service, which we would use our own software to essentially help people find an Airbnb, stand it up, do those things. We did about $1.5 million in revenue, like in 45 days. We thought we were onto something. And then we were on a Zoom, kind of similar to what you and I are doing right now. And everyone was like, almost like jealous, or the grass is greener on the other side. They're like, wow, Ali, your Airbnb is awesome. Wow, Craig, your Airbnb is incredible. I wish I owned that. They were describing a portfolio or a syndication. And at the time, we were operating one-to-one, which is not super scalable. And instead, if we were a portfolio, we could operate one-to-many, because now it's just like speaking the same type of data to the consumer. And I said, well, what if we rolled all of these into a portfolio and not like seed the portfolio? And every single investor was ecstatic because we still were solving the same problems, right? It was keep it passive, cash flow, do the thing. But now they owned a piece of 8 properties, right, across the country instead of their own share or 100% of one. And we launched to our friends and family in the next, roughly 3 days or so. We raised $7 million in 30 days. We were like, product market fit, right? Like we hit it on the head, solved it, and then the rest is history.
Your mom must have had a lot of money under that mattress she had, huh?
Ironically, my mom actually, she gave me 15 grand to invest in real estate when we first started this business, and I took it because I wanted her to feel like she was investing, and I didn't want to tell her how little 15 grand would go,
Yeah.
Towards that golf simulator that you were doing. But I think she's happy with her return so
I
far.
bet.
She's got all her money back, and she's got 2 grandkids, most importantly. So she's all
Amazing.
good.
Amazing. Man, so you've built this pretty successful business overall, right? And so now looking back, right, it seems like this didn't take you very long. When did you quit Facebook?
2020, 2021, roughly. And then this business started in middle to Q3 2021.
Okay. So it's like 2 years old, this business, which is almost funny. Like you almost probably laugh when you think about just 2 years old and this is how far you've come. And so just to kind of like, to all of you listening that might just be starting out, right? Like your Sief's 2023 could be your 2025. Like that is not that far away. You find the right resources, you use the education and skills that you have to actually grow something meaningful and put it all together. And like you've amassed a pretty big portfolio. And how much of that would you say, like how much do you call them GPs, like general partners? Like, are you the general partner of the operator?
Well, we're the GP.
So what's the typical structure of your syndication, like between the GPs and the general partners and the limited partners?
So we offer a preferred return, and that just really means our investors get paid before we do, right? That preferred return is going to typically between 8, 9, and 10%, depending on their class of share, right? It really dependent on how much they're investing, right? If they invest more, they get a better advantage, right, in terms of class of share. It's just scalable capital. And then they're typically going to get a split beyond that. The average split we have today is roughly an 8.5 pref, followed by about a 70-30 split. So we own 30% above an 8.5% preferred, right? And that's roughly, give or take, what our general partnership, promote is. Now, just for anyone listening, general partners can make a lot of money, and I want to call a spade, but they also have to perform, right? They have to go out and do these types of things, and usually a lot of general partners get paid. Really, the bulk of their money they make at the end, right? So our business plan, our thesis is package this up in a portfolio, sell it to a large institution, because most institutions we've talked to, None of them have an interest in building this because it's really hard to build brick by brick, but they have a really big interest in buying it, right? They want that stabilized cash flow. They want that portfolio. The work's been done. But they don't want to, take the journey of going to build it. So they're like, if someone will go build it, we have a pretty high interest in buying it.
So what would the typical investor avatar look like for you, and what are the returns that they get?
Yep. So we're a 506c, which means every investor has to be an accredited investor. So typically they're going to qualify with either income or net worth requirements, typically making 200 to 300 grand more per year, depending on their filing status, or they have $1 million net worth outside their primary residence. And they're typically working in technology, in business, in healthcare. They're, in a high income earning professional. And they're looking to be a passive investor in something, right? Usually people that find us or come to us aren't searching short-term rental investment fund. That's the irony here. No one actually really knows what we do exists, right? Kind of what they're searching for is real estate investments or passive real estate investing. And then they come across asset classes as part of that journey. They come across multifamily and single family and, being a landlord and self-storage and land and farmland and crypto and all these other things that are options to invest on the planet. And then, we're in front of them as like, hey, well, we're real estate with a twist, right? Something that like, and love. Most people have stayed in an Airbnb. People also remember how much they paid for that Airbnb. And they're like, wow, the owner must be making money hand over fist. So like those mental psyches typically kind of come through. And the average investor avatar is, okay, I know I'm a high income earning professional. I can't trade. I don't want to trade time for money. Therefore, I need to be passive. I want tax benefits. I want cash flow. I want diversification. This is an option that fits my portfolio. Rarely are we ever someone's first investment, right? Just because you got to be accredited, and usually the first thing you're doing is not putting all your net worth into a short-term rental investment fund, right? Especially given that what we're trying to accomplish over a 5 to 7 year period has really never been done before. If we're right, it'll feel like a grand slam, right? If we're wrong, it'll feel like a double. And that's a risk exchange that we're very much willing to take. And that's what we tell our investors, right? Worst case, we have fixed rate debt for decades. We can cash flow. And if everything goes to shit, we'll continue holding. Like all those things kind of continue to go. So that's typically what you'll see in terms of the average avatar.
I love that. Okay, we're gonna have to get into the final part of our show soon, but before we do, I got one last question. Maybe it might be a couple more questions. Have you sold anything yet?
We did. We sold 8 in 2022, roughly around Q1 and Q2, and it was more of a test for us. We wanted to understand what the retail market would value and would understand or appreciate a turnkey short-term rental property. And we were kind of just taken back with how much demand we had for those properties. All of them sold for well above. I think they sold for between like a 5.5 and a 6.5 cap rate on a single family basis. And the crazy thing is most of them were off of projected revenues, right? Because you didn't have T12s, you didn't have T6s. And with stabilized revenue and pro forma and actuals instead of projections, things typically sell for higher premiums, right? Because of the risk reward. So for us to get that type of return, we were like, holy shit, like that's amazing in terms of the arbitrage opportunity. So it proved to us that there was retail demand. That's an option for us to exit. I don't know if I would wish it on anyone to ever sell 120 single family homes. I mean, selling is hard. I think not a lot of people talk about how hard it is to sell in general. But if that's the outcome that we end up having that we believe is best, then I think we'll be well positioned. And I think we have some data that proves that it can be successful.
So then what's next for you in the future? What are you looking forward to?
Yeah, so for us, we're committed to doing a few things in the industry, right? And the first one is continue to bring a passive opportunity to folks who want to invest in this asset class, but they lack the time, knowledge, know-how, or perhaps want to do it themselves. We used to have a $250,000 minimum. Our minimum is $25,000 today, and that's still a lot of money, but that's a 90% reduction in terms of accessibility. And people ask us, well, why hasn't that number even gone down further? And really, it's about business economics, right? We need to be able to have enough scale and margin in order for us to grow. And we're not venture funded, right? Like our entire competition in this industry, I think they're all venture funded, right? We've never taken a single dollar of outside capital. We don't have to sell. We don't have to go IPO. We don't have to do a single thing that isn't out of making sure we prioritize the experience in the real estate for our investors.
So if your mom came to you with 15 grand, would you say, sorry, ma, I need another 10?
I think depending on the valuation she would ask for, but she'll probably say I gave you life and I'd have to give in. So,
Yeah,
and I think she'd be
that's the
right.
right answer.
she,
Yeah, yeah.
you know,
There are a couple of people you make exceptions for, and I would say if your mom's not one of them, then maybe you got to check yourself.
she has equity naturally, right? Just through
Yeah,
owning this, but yeah. So those are things that we're focused on, and we're also highly considering, open sourcing, for lack of a better word, or releasing some of our tools and infrastructure to other people like moms and pops. Like we get a ton of inbound demand for people saying, "Manage my property. Can you guys help me with this? I've seen this that you guys can do this. Like, can you help me with that?" And those are things that we're seriously considering. Like we own a bunch of IP in the industry. Like we could release our tooling infrastructure and you could upload your data and see all your visualized data. Maybe that's a tool we release, right? Maybe we get into third party services, right? There are things that we're considering, but today we're hyper focused on making sure that we build the right tools and infrastructure for the success of our portfolio. And by nature of doing that, we're building the same exact tools that other people will depend on as well.
I love that. And so, what are your, I guess, the people that were questioning your decision a couple of years ago? Your mom, maybe your other parts of your family, friends, your peers. What do they think now?
I think something that not a lot of people talk about when you hit any level of success, and I think we're far from, what we ultimately want, but I think we can all agree that we've come much further than we thought we would in a short period of time. And I think there's something to be celebrated there. I think a lot of people oftentimes don't cheer you on after you've hit a certain point of time, right? And I think people evolve, and this is not something people talk about often openly. You lose friends, you lose time, you make tough decisions. And for me specifically, right, I became a parent, started a business, and a lot of other things didn't become a priority, right? Because you have other things that become a priority. Building a business from scratch and becoming a father at the same time, things got to give. And I think you have some people who recognize that as good, and I think you have some people who recognize that as bad, right? And some people cheer you on from afar, and some people don't, and those things are known. But I think ultimately you have to always ask yourself, what do you want to do for yourself and for your future? What are the things that matter to you? And clarity, I think, is such a big thing that not a lot of business owners really have an understanding of, right? They're just so dead set on some business goal, but they oftentimes forget, why are they building this business, right? And I think ultimately knowing your why is really important. And for me, it was financial freedom. It was being able to spend time with my family. It was being able to be a present father. It was, being all the learnings and failures that I had growing up and rolling that into what I think this could work, and identifying an opportunity that you feel passionate about. So all those things I think are really critical to how I think people would perceive you.
I think you have to recognize that when everyone is in your life for a certain season, most people, right, outside of family, and when you make transitions or when you change, when you become an employee versus a business owner, you are going to have an entirely new set of friends because your old friends that are employees still cannot relate to the business owner, can't relate as to why you're working at Saturday morning at 10 a.m. if you have to, right? And so you start to have more friends that just have similar interests aligned. Doesn't mean that you dislike these people anymore. You can still probably go meet up for them for a beer and have a good time and catch up, but you find yourself not hanging out or talking to them every day like you might used to have been.
Yeah, it's a very good way of putting it, Craig. I think you have a lot of people naturally who also just, they don't know where they're going, right? And that's okay, right? Like I think I want to be very clear. Like we've pivoted probably like almost a dozen times, and by pivot they could be huge pivots, or they could be super small pivots. I mean, we uprooted our family, we moved. I mean, when I talk about pivots, you talk about personal pivots, work pivots, business pivots. All those things affect your business. So wherever you're at in your journey today, it's okay to pivot. And it's terrifying to pivot, but it's okay to pivot. And I think people think pivoting is just what their business is. Pivoting could be your mindset, it could be your family, it could be your priorities, it could be your approach, it could be your clarity. And like one thing I recently got back into is I used to love to read, right? Like I get a lot of my creativity from reading, and like I spent a year and a half not doing a lot of reading because it was like deep work and all these types of things. And I just started reading again more recently, and like I feel like my creativity is right back, right into the things that I bring my what I like to call, and Sabrina actually educated me on this, and I forgot who came up with the word. Like my zone of genius is like when I'm in that creative moment, right? And it's when I read and I understand, and I'm not working, right? So I think people just should be really appreciative of that type of stuff in their own journey.
Yeah. What type of books are you reading for creativity?
So I typically like business books. I give every book generally a fairly good shot. Like right now, I'm reading $100 Million Leads by Hormozy, right? Just generally understanding that a little bit better. I'm rereading Traction. I'm reading Modern Monopolies, right? And the reason I'm reading Modern Monopolies, something that interests me about that book, and I'm forgetting the author, is our goal, and we've trademarked it, the STROS, is we want to own varying levels of the short-term rental operating system. So how can we do that, right? How can we own modern monopolies? And there's oftentimes business opportunities right in front of you inside your own business. Everyone's always looking for that sexy thing outside of it, but oftentimes there's so much opportunity sitting right in front of you.
Gotcha. I love that, man. I love it, man. Well, hey, I love your story, dude. I love kind of where you've been. I love how you got here, and I love where you're going. With that being said, I think we're going to have to head into the final part of our show. But do you have any other words of wisdom before we get there?
I think we hit on a couple, Greg, but I think the biggest one, just even like repeating my own self, is pivot, change, go get it, change, pivot. Cannot say that enough. I think people are oftentimes reluctant because of ego and pride and what people will think and failure and fear of all those types of things. And look, I was one of them. I still am one of them sometimes,
Mhm.
right? And that's totally okay to accept. But try to surround yourself with a community of people who will support you, because ultimately you will need it. You'll have days where it's hard. Building isn't easy. It's very hard.
Totally. I love it. All right, Allie, you know what time it is?
It's time for the final
Final
The final
four. Ba-dum-bum bop. Kick us off, Allie.
I started this a little while ago, but so typically the question is, what book are you currently reading? If the books that you've already mentioned you're currently reading, mention another one. Maybe what's your favorite?
I think one that I've really been super interested in to read, I have it, but I haven't read, is actually Buy Then Build. And it's a book about buying a business first and then building and growing it rather than building a business to start. And the reason I'm really interested in that right now is just primarily with the understanding what it took to build a business, right? To get to this point, I'm hyper curious about what it's like to buy a business then build it after, right? So, and just understanding what the trade offs are. So that's more of a curiosity thing.
Very Cody Sanchez. I like it.
Very Cody Sanchez.
It's a Walker Deeble.
Yes, Walker Devil.
I read that book this year. It was very good. So, Kumia, what is the best piece of advice you ever received?
I think that one of the first things that comes to mind is don't care about failing, right? I grew up like immigrant household, go get straight A's, go be a doctor, right? Like type of a thing. And, failure was like, you either did really well and were almost damn near perfect, or everything else was a fail, right? It was pass fail. And, that's not life, right? Life is a spectrum. And I think when you take that perspective and know that even failures are wins at times, puts things into perspectives. The best things I've ever done have come from failure.
Yes.
Totally agree with that. Love it.
What is your why?
My kids, by far. I mean, easy decision. I have two boys. My youngest is turning one tomorrow, at least at the time of this recording. We're doing a one happy dude.
Happy early birthday to him.
Thank you. We're doing a one happy dude birthday celebration. He's the smiliest, chubbiest little guy in the world. But my kids are my biggest why. Spending time with them, seeing their smiles, and I have the privilege of working from home and taking a 5-minute break and going out and seeing how they're doing and giving them a hug and picking them up and playing airplanes and doing all those things. And those are my why. And every single time they go to bed, I whisper in their ears and I'm like, if you ever get real estate from us, never sell it. I was like, refinance, don't sell. So I hope they'll take that. I hope they'll take that advice when they're 25 or 35 or however old they're going to get when they receive it and they do something good with it.
I love that, man. I love it, love it, love it. Um, okay, man. If you had to describe your personality using a kitchen appliance, which one would it be?
Probably a blender. I feel like a blender. Yeah, I'm a
There's no hesitation there. I love that.
There was not. Then yeah.
no hesitation. No hesitation. I was thinking about our kitchen. And I was like, oh, definitely a blender. I feel like you put me in any room and like I'll go bouncing off the walls, and not in a bad way, just good ideas and energy and charisma and all those things I think are strengths of mine as a leader. And I lead with no regrets and just my natural raw self. And I think that's how most of my team, my family would describe me. I hope.
Yeah.
I hope they don't tell me I'm a
Yeah.
toaster, but we'll see.
And maybe you put a bunch of things that just taste okay into one
Yeah.
thing, make it together, and it tastes real good, right?
If you ask me, that's what leadership is, Craig. That's all leadership is.
Yeah, we could be going deep with this analogy here that was totally not expected, but yeah, I mean, if you think about it, right? Like bananas are good, but like in a smoothie, they're way better. Like blueberries,
Agreed.
like protein. You're not going to drink protein powder without
Yeah.
not in a blender.
There you
Right?
go.
I don't know. So okay, I'm going down a rabbit hole here, but all right, Sief, where can people find out more about you?
I'm on LinkedIn. You can reach out, Sief at techvestor.com. You can reach out to our team at Techvestor if you want to, learn more about investing or about short-term rentals or follow the story or view some really awesome photos of the things that we do, like we're building an outdoor like city for kids in one of our yards right now, right? So like, those are the types of things that we do. And if you want to just curious and just follow the story, we're at Go Techvestor or Techvestor on most social channels as well.
Dude,
Awesome.
this is amazing. I'm just looking at it now, and it looks very sexy. So, awesome, Sief. Thanks so much for coming on the show, man. It's been a pleasure having you. Pleasure to hear your story and how you're just taking a different approach to short-term rentals and allowing people to invest passively in something that you never thought could be passive. So, thanks again, man, and definitely we'll be in touch.
Thanks, Steve.
Thanks for having me, guys.
And that was Sief Khafagi. Gosh, I just want to say, I'm like, when you get a song stuck in your head, and you just want to sing it all day. Like, I feel like I'm going to walk into my house and be like, Sief Khafagi. And Grace is going to be like, what in the world are you saying?
I'm down. Let's record it.
Yeah,
I'll do it with Britt too.
Yeah, done.
I'll send it to you after.
Yeah, what did you think of Sief, Allie?
It was an awesome episode. Really struck some chords with me because I'm pretty sure I've been vocal about this before on previous podcasts with you, that I have short-term rentals, that I am moving into medium-term and long-term rentals. I'm actually selling one of them. So because Tucson, Arizona, they have been middle-of-the-road properties. So in this episode, he really talks about how he makes his property stand out. It's more than just a place to sleep. That's, short-term rentals went from a place to sleep and being able to profit off that to it really needs to provide everything. Like he leaves no aspect untouched. So that's where I do not have the time to spend on that. So Sief, Khafagi, don't yell at me, but I'm selling one of my Airbnbs.
He's going to be like, I'm not yelling at you. Tell me, let me buy it.
Yeah.
Yeah. No, I totally agree. I mean, you can just see if you look on his website, like techvestors.com, the quality of work he does to his properties is bar none. Like if you were scrolling on Airbnb, his property will stand out. Whereas I know that my properties, they're kind of run of the mill. And he's right that, hey, yeah, I'm probably competing with hotel rooms in my 1 bed, 2 bed type stuff. And I mean, I do think that it's nicer to have a kitchen, nicer to have a yard, nicer to have, you're not just in this concrete jungle with people to the left and to the right of you, like in an Airbnb. But yeah, I mean, he's right that there's nothing really like that. It's just the VRBOs. The only thing that I'd be maybe slightly worried about is in a recession, right? If people aren't taking these vacations or aren't doing these trips as much, what happens? And so, yeah, but overall, I think he's diversified enough in enough different markets that I think he knows and he can pivot. Like, I don't think it's his only strategy. So
Yeah, definitely. Yeah, I'm sure that he's thought about that too. But I agree with if something else were to occur, another pandemic, another something that we cannot forecast. That is something to keep in mind. In Tucson specifically, I'm seeing that studios are doing the best. Had I purchased studios instead of single family homes, I would be doing way better than I am right now on my short-term rental side. So it's so interesting. It's so different market to market. So definitely get with a real estate agent that is investor friendly and knows and hopefully even has properties that they can teach you about that specific market.
absolutely. Love it, love it, love it. Well, if you guys made it this far, it means you must really love us. And if you really love us, that means you should totally leave us a rating and review on iTunes, on Spotify, wherever you're listening right now, which just helps us tremendously. Give us a follow on Instagram. I'm the Fi Guy. Allie is Allie the Agent. And with that, we will see you all next week.
That's it for this episode of Investify. We hope that these nuggets of real estate wisdom lead to more savvy financial planning and a clearer path towards financial freedom. For more content like this, subscribe to the show at investify.com. Don't forget to leave a rating and share it with your friends. Together, we can transform more real estate newbies into successful and clever investors. Thank you so much for listening. See you on the next one.